If you are an investor in AMD and Palantir and Tesla or Nvidia, this is the video for you. Today, we're going to be covering some of those names and all kinds of others, but the main point of this video here is to give you free advice from a professional investor who's been doing this for 16 years. So if you're ready to learn how to actually trade and not just follow the meme stocks that you see, you are in the right place. So what we're doing in this video today, this is an Ask Me Anything video. And I've already curated a handful of questions that I want to answer and, of course, help you out in the process. So the first question from Regio says, can you please go through the predictions options swing range through earnings? Now, the way that I would call this is the expected move for earnings. So do me a favor in the chat. Tell me a stock that you know has earnings coming up, and we will look at that together, right? We'll look at that together. We will pan this out. But before we get there, let me show you the process. The way that you would do it is, in fact, let's go to HIMS. HIMS says earnings right here. Let's look at HIMS earnings, okay? HIMS is going to have earnings before August 8th. So within the next 14 days, it's going to happen. This is the closest options chain to that expiration point, all right? We see that. Now, the way that you price out the expected move is you go and price out the at the money straddle. So that looks like buying a call, so clicking the ask button, buying a put by clicking the ask button, and then we look at the price of that. So the price of this on the cycle, the expiration cycle where earnings is at $11.02. Now, we take one step further, because the market makers know that there's a lot of uncertainty at earnings. And so they juice up the price of the options. So the rule of thumb, to get back to what the expected move actually is you take the at the money straddle price, which is 1102, and you multiply that by 85%. So the expected move for HIMS by August 8th is $9.36. Now, of course, there's not just earnings coming up. You want to get to as close as earnings as possible. You want this to be 1 or 0, right? Because now you've also got time baked into this as well. But this is how you calculate the expected move getting to that point. Now, 936 on HIMS is a big number. HIMS is a $57 stock. A $9.36 move up. This is not percentage. This is dollars. $9.36 up is about 16% up. $9.36 down is about 16% down. So a 16% move. That is huge. So the expected move is $9.36 up or $9.36 down. That is the expected move at earnings. Now, we don't know how it's going to actually end up. And because of that, that's why the earnings are what the options are so juiced up in price. It might go up $1. It might go down 50 cents. It might go down 23%, or it could go up $15. We don't actually know. And that's why the options cost as much as they do. Now, the other thing to keep in mind is if you do buy this within 1 hour, literally 1 hour of the opening after earnings, once we know what the price is going to be, this price will absolutely collapse. This price may be $11 the night before, but by 9:30 Central Time, 1 hour after the market opens, it's going to collapse. It might be worth $2 at that point. So you could lose 80% of your options trade value within the span of an hour if you do this. Okay? Don't do this. One of Chris's big rules is if I can avoid trading through earnings, I will. Now, what do I mean if I can avoid? If the trend line that I'm following, so normally it's the 10 EMA, if that is broken by the expected move, I would have gotten out anyway if it breaks through the 10 EMA. That would be my trailing stop. So if the expected move breaks through that point, I'm not going to be there. You're not going to find Chris there. It is a very rare occasion where Chris will actually hold through earnings. In fact, the last time I did it was Bank of America. I think that was in February. And it was totally by accident because I did not realize that they had earnings the next day. And I was smiled down on the market gods. It opened up 5% the next day. And I was very happy, boy. But that was absolutely a trading mistake. I did not know until after the close. So that is how you calculate the expected move. A fantastic question to start off today. Let's go to the next one here. How much cash should you have at startup? So that's a great question for a couple of reasons, right? When you are starting trading, I want you to do a few things, and in this order. First, come up with a plan. Just a plan. Second, start paper trading that plan. Whatever your plan is, start paper trading that plan. That plan needs to be rules-based, needs to be specific, needs to be measurable and quantifiable. This is not, well, you know what? This guy was talking about HIMS or Palantir, the other thing on YouTube. I should buy that stock. That's not a plan. That is not a plan. That's a hope and a dream. All right. We're not here for hopes and dreams. We're here about following plans. Create a plan and start paper trading that plan. After you have successfully implemented that plan, I want you to start using what's called a Monte Carlo simulator. Now, I believe I have one handy. Yes. You can Google free Monte Carlo simulators. You can probably get ChatGPT to do it for you, whatever the case is. After you have created that plan, after you've paper traded it, after you've back tested it, after you have proven with data, and the only way you can do this is with data, by the way, that you can follow that plan and that it fits your lifestyle. This is really important. If it doesn't fit your lifestyle, it's not going to work, right? I've tried to day trade on multiple occasions. I've made money, I've lost money, but basically what I've also lost is hair off the top of my head and years off my life from day trading. I am not a day trader. I was not built for the amount of excitement, and not in a good way, right? I don't want that anxiety. I don't want that excitement. I don't want to be walking into a casino every day and hoping for the best. I am an investor. I will take strategic investments and I will wait for that to play out. I don't want to be doing this all day, right? My lifestyle design is not to be sat in front of screens all day. Yours may be, and you do you, but for me, no way. So you've created a plan, you've back tested it, you have data, and you figured out something that works with your lifestyle design. Go into a Monte Carlo simulator, and I'll throw my numbers in here just for fun for 2025. Hold tight. All right. So these are my returns so far this year. Now, I did suffer a decent losing streak, and it hurt me pretty bad. And that's the mother of all invention, right? The reason that we found some new data points is because I suffered through this losing streak right here. And I thought to myself, where am I going wrong? Is there some data point that I already have that I'm not acknowledging? And the answer was yes, right? Now I'm still up over 20% for the year, so I'm very happy about that. But 20% coming down feels a hell of a lot different than 20% going up, right? We can all agree to that, right? It feels great to make $1 million a year when you're, not making $1 million before that, but it feels like terrible donkey doo-doo if you were making $10 million a year and you just made $1 million this year, right? Perspective. So looking at this, we can put my numbers into a Monte Carlo simulator here, okay? So my win rate is lower than I want, 46.88%, but that's okay because I have improved my trading plan. My average win, 47.48. You can just throw numbers in here like this, 47.48. Next, you can do your average loss, 28.73 in my case. Now, this has positive expectancy, right? Positive expectancy means on average, I have returned nearly 7%. On every trade that I've ever put on this year, my average return per trade is 7%. Can you say the same? That's actually really great, right? If you have a positive edge, that is the goal. Now, throw this into a Monte Carlo simulator, and what you want to see is the worst case outcome still being positive. Now, this doesn't hit the numbers that I want to see this year. It doesn't. My worst case outcome is still profitable, but only 50,000, right? My average outcome is 257,000, which is great. My max outcome, 483,000. That's awesome, right? The objective here by using the Monte Carlo simulator is to focus in on your worst case number. And like I said, this is not good enough for me. Not good enough for me at all. Because of that, that is what has prompted me to start seeing, okay, where can I make some changes to my trading plan? Which is exactly what you need to be doing as you're starting out. Creating that plan, back testing it, paper trading it, making sure it fits your lifestyle design, and then look at the results here. If the results are positive, if your worst case scenario makes you wildly profitable, then you're ready to graduate from paper to real trading. If your worst case scenario does not make you wildly profitable, and for some people, $48,000 is wildly profitable. For me, that's not good enough, not even close to good. That's 10 times less than I want to see. So looking at this, I would say I need to make modifications to my plan. I made modifications to my plan, right? The professional investor teaching you invaluable lessons right here. This could make you literally tens of millions of dollars if you understand what I'm talking about here. Now, you've paper traded, you've come up with the plan, you fit your lifestyle design, and then you've figured out a way to make your worst case scenario wildly profitable. At that point, now you're ready to start trading real money. At that point, real money. Now, during this time, this may have been 6, 8, 12 months where you're coming up with this, right? A doctor does not walk into the surgery theater and start working on brain surgery 6, 8, 12 months after he started. No. Bro's got like 16 years of education to go through first, okay? So you've created your plan, you've back tested it, you've proven you're going to be wildly profitable. Now start trading with one share. Oh, Chris, what are you talking about? I can't wait this long. Okay, first off, in the time that you have been backtesting, you probably should have picked up some great books. I'll recommend you 5 books as well. These are my top 5 trading books. Number 1, The Complete Turtle Trader. You need to get this one. Fantastic book. A lot of how I trade is in that book. Number 2, How I Made $2 million in the Stock Market. This is a tremendous book. I love it so much, and I actually am friends with Steve. Steve added commentary to this book to make it even better. Number 3, Trading in the Zone. This is the Trading Psychology Bible. You must get this. Number 4 is not this one. Number 4, this is my number 5. Hang on. Number 4 is Trend Following. If you can get the 2012 version, get it. This is the best $10 I ever spent in my life. Not even close. Best $10 I ever spent in my life. The 2012 version is a lot easier to read than that big old fat one right there. It's the same book, but 3 times as big. And then the best book you should get is New Trader, Rich Trader. This is available for about $10, and you can also get it on Audible. It's a fantastic read. So much of what I do is in this book. In fact, because I know Steve and Holly, that's his wife. And it's funny because a lot of people say, Chris, were you the new trader in New Trader, Rich Trader? No, he'd written this before I knew him, but there's a lot of similarities. Okay. So during that time, while you're back testing, proving that it works, right? You're reading these books, and then you're also saving money, right? Do not even think you're going to walk in the market with $1,000 and be like, here we go. Let's turn this 1,000 into $1 million. Not going to happen. Okay. During that time, I would encourage you to save as much as you humanly can, right? As much as you humanly can. And it's going to be different for everybody, right? $1,000 may be a giant struggle for you to save over the course of a year, but let's break that down. That's like $80 a month. Okay. If you didn't go out to eat a couple times a week, you could come up with $80 over the course of a month. I would encourage you to start with at least 5,000. I started with $5,000.15. How do I know that? Because when I started trading, I found a broker, and the broker needed a $5,000 initial deposit. And I'm like, okay, how can I come up with $5,000 real quick? And I found this old 401k that I never contributed anything to. And it was from an old job. And I was like, I wonder how much is in there. And I cashed it out, and I got the check in the mail. And I believe that there is a higher spirit that calls us to different things. And this very moment was when I was like, okay, this is bigger than me. This is so much bigger than anything I can ever think of, which is also what led me to helping you out here today. I got the check in the mail, and I'll never forget standing in the kitchen, ripping it open, knowing that I needed $5,000 to open the account, and the check was exactly $5,000.15. I was like, I still get goosebumps to this day. Like, I still know that the Lord Jesus looked down upon me and said, you are going to be a trader. And that was the moment that the light bulb clicked for me at that moment. Like, whoa, this is bigger than I know. So my advice is to go through that order and save. If you can get to $5,000 over the course of a year, do that. Don't start with 1,000, The reason being is that you're not going to have enough money to position size correctly. When I say position size correctly, if you have $1,000 and you buy, wait, hang on, let's look at a few names. Let's say you have $1,000 and you buy one share of Tesla, which is 305. You buy one share of MicroStrategy, which is 414. And you buy one share of Palantir, which is 150. You've basically put your entire account in 3 shares. That's it. 3 shares. Okay. You can't do it. It's not going to work. With $5,000, you can at least start to get into the game and position size correctly. Now, I would also at that point start by looking at less expensive stocks. I would have a filter to say nothing more than $40, maybe nothing more than $50, because then you can position size. You can get up to 100, right? 100, 2 times 100, no, 100. Yeah, you can get up to 100 shares at $50. Because 10 shares would be 500. Yeah, 100 shares. Which will really help you. Don't even think about going into options. Just trade shares and just start with one share of these. After you've figured out how to trade with one share, after you've proven that plan you created, you can actually do with real money, right? Because the theory is one thing, right? Coming up with the plan is so much fun and grand and exciting. You've saved $5,000. You've read the top 5 trading books, and you've proven with the Monte Carlo that your worst case scenario is going to be wildly profitable. Then you get into the market. The first trade you put on happens to be a loser. You stare at the screen like deer in a headlight. It goes against you. You're losing money day after day. And you're like, that's okay. It's okay. I'm just going to move my stop a little bit. And day after day, you continue to make the same mistake over and over and over. And I know because I did this. You can hear the passion in my voice because I did this. It's okay. I'll give it one more day. It's okay. I'll give it another $1. It's okay. I'm going to let this play out. It's okay. I love the stock. I'm going to hold it forever. That's eventually where people end up at. Don't do that. Follow the plan. You're going to lose in your first year. Just be ready for it. 90% of traders lose 90% of their accounts in the first 90 days of trading. That is the normal stat across the industry. The way you can avoid that is exactly what I'm telling you. Exactly what I'm telling you. And if you're year 1, you can break even. If by the end of year 1, you've broken even, which would be better than I did, hellaciously better than I did, you will be in the top 10% of traders. And I know that sounds crazy, but it is a fact. If you can just break even on that $5,000, if on January 1st you have $5,000.15, and on January 1st the next year you have $5,000.15, you have done it right. You are in the top echelon of traders. Then start expanding. All right. So that's my rant. That was a great question. And I'm super passionate about it. Super passionate about it, as you can tell. There you go, Brendan. That also answers your question as well. Sharon says, what's the best strategy to put a stop loss? I put stop losses even at 5 to 6% below, and the stock fluctuates, hits my stop loss, and shoots up. Okay, Sharon. Great stuff here. Really amazing question. So I base my stop losses on the volatility of the stock itself. Now, the great thing about what you just asked is you put it at 5% or 6% below that price. Okay, let's look at HIMS. We talked about the expected move already on HIMS, right? The volatility on HIMS. Let me remove some of this. The volatility on HIMS is quite high. How do I know this, right? You can look at the chart. You can say, oh yeah, that's high volatility, or you can measure it. The way that I measure it, I'm gonna drop comments off for a moment here, is this indicator called ATR. I don't do a lot of indicators. I have the 10, the 20, the 50 EMA. Those are the only lines on my chart. The other thing down here is called the average true range. This measures the volatility of a stock. Now, what's cool about this is you can go back and you can say, okay, back here, when HIMS was a lot less volatile, the volatility number right here, look all the way on the far right-hand side of my screen, and you'll see a black number that says 0.8395, 0.8395, meaning that the average true range over 14 periods, which is default, was 84 cents. 84 cents over 14 periods. Fast forward over here, where HIMS had that giant move, the average move over 14 periods was $6.71. So the moves here were 8 times as large as the moves here. Because of this, if you had the same position size, you just exposed yourself to 8 times as much risk as you did earlier that year. 8 times as much risk for the same position size. Same on your stop loss. Your stop loss just became 8 times less usable than it did earlier that year. Okay. So the way that I position size is based on volatility. The way that I set my stop loss is based on volatility. I use a half of an ATR as my stop loss. So we're marking this chart up because this is one that I'm going to be following for some testing that we're doing. And I've actually already marked on the chart what a half ATR looks like. So you take this number, you divide it by 2, and you subtract it from your entry price. That is the half ATR exit. And as I mentioned my 5 favorite trading books earlier, that's what these guys did in The Complete Turtle Trader. Half an ATR as an exit point. Will there be times it strikes that exit and it bounces back up without you? It is a fact. Just be okay with it, right? Just be okay with it. In fact, I have a slide for this. Just be okay with that happening. Because there will be times where this happens. You bought here and you set your stop loss right here, knowing you should sell when it hits that. But you're not you personally, but as a whole, Sharon, you're nervous, right? You're like, oh man, I don't want to sell out down here because it could just pop back up and go on without me. Or what can actually happen, get you caught in this situation right here. Because in reality, this is the more likely of the two that's going to happen. If your stop loss has been hit, it should have been a red flag to you to say, okay, my bullish thesis, my bullish case has been invalidated. One quote from this book, How I Made Money in Stocks. I love being in the library. Being in the library is so much easier than the Outlier Global World Headquarters. One quote in this book right here says, a winning racehorse doesn't back up into the gates. If your stop loss is hit, take it. You don't have to take it right away. I take mine at the end of the day, right? If it wicks down and then comes back up, that's fine. But if it wicks down, stays down, and closes below your stop loss, it is time to go. It is time to go. So that's my opinion on stop losses. Don't base them on percentage. Base them on the volatility of the stock because it will change all the time. Max has a great question. Why do some stocks like NVIDIA, Tesla, and AMD have high extrinsic value even at above 80 delta? All right, let's go look at those. So let's do a quick options understanding of what this means. Intrinsic value is based on what the current price of the stock is minus the strike price. So we'll use the 50 strike right here. In fact, watch this. Math always works. Okay, ready? If the current price is $57.19 and the strike price is 50, the intrinsic value is $7.19. This is the moneyness. This is how deep in the money it is. Okay. Now the extrinsic value, this is the difference in what the actual price of the option is and the intrinsic value. So if I actually, let me subtract. If I subtract 9.85 from here, you're going to get 266. Now, of course, it's moving around a lot, so it's going to change a little bit. But that's why the extrinsic value shows $2 and change. Okay. We understand what both of these are. Intrinsic is how deep in the money it is. Extrinsic is our uncertainty value. There's lots of stuff built into extrinsic. There's what's the changes in interest rates? That's your row option Greek. That one doesn't matter. There's Vega. This is the volatility. That's based into your extrinsic value. And then there's theta. That's also baked into your extrinsic value. So your extrinsic value is not just one thing, it's multiple things. So to Max's question, why do some even at the 80 delta have such high extrinsic value? So let's go to AMD. Mostly, first off, Max, these are like the popular stocks right now. And because of that, the market makers are going to juice this up. No matter what, they're going to juice it up. So if we look at the 80 delta on the extrinsic value here, let's go to the 80 delta. The 149s on this strike is the 80 delta. All right. That's where Chris lives, is in the 80 deltas. Now, you'll notice the intrinsic value being $14 is super high because it's, $14 in the money. Okay. The extrinsic value is going to be roughly around 20% every time. In fact, let's calculate this. I don't know what it's going to be, but I'm going to say it's roughly 20% or so. So 2.4 divided by 17.15, 13%. So Max, even though it feels really expensive, it's really just a percentage of the option price. So that was AMD. Let's do the same on NVIDIA. Okay, this is NVIDIA. Let's clear this. Let's go to the 80 delta here, the 162.50s on this strike, on this options chain here. Now let's calculate the percent of extrinsic value to ask price. So $1.33 divided by 1220, 10%. It's even less, actually. It actually means it's a good deal. And then let's do Tesla. That was the other one he asked about. Let's do Tesla. And let's find the 80 delta up here. Then let's calculate. 395 on 26. 3.95 divided by 2660 is 14%. So in reality, Max, it's not that they are expensive on their own. The extrinsic value is really just a function of the percent of the overall option price. And it's really always in that 20% ballpark. It might be lower, as you saw. It might be higher, as you might see as well. There's nothing wrong with what you're doing at all. That's where I live. Right? That's where I always say I want to see 20% or less. I'll fudge it up to 30% at the very, very, very most. But that's where Chris lives. So fantastic question. Now, that's also why Chris doesn't care about theta. Chris doesn't care about Vega, because I'm so deep in the money that it usually always hits right at that percentage, which is what I want anyway. So if it's really juicy, if it's really expensive, I'll just move up the options chain. No stress. But that's a fantastic question. You know what? Brandon has a great question. Where can I learn more in depth about options? Well, in fact, not just options, but I'm going to teach you everything that I know 100% for free over at
Are you ready? Let's go!
Respect is earned. Respect is never given.
That is right. Every Tuesday and Thursday, we go live with a group of gentlemen here on YouTube, and I'm teaching them literally everything that I know about trading. I'm not holding anything back. As you see, I don't hold anything back ever. There's no masterclass to go to. It's all for free out here on YouTube. And Outlier University is where I'm teaching these gentlemen who only have 1 week of class left how to change their lives, how to create generational wealth for the future. In fact, some of these guys have already posted multiple 6 figures to their trading account, and they have not even finished their coursework in Outlier University. That is how awesome Outlier University is. And here's the best part of all. Outlier University comes with a free 100% money back guarantee if you don't love it, because it's free here on YouTube. All right, that's the joke. That's the joke. But in all reality's sake, 50% of you are going to listen to the lessons in Outlier University passively. You're not going to do anything about it, and you're not going to change your lives. 25% of you are going to listen, but only half-heartedly. You're going to go implement something. You're going to do it wrong. You're going to lose the trade, and you're going to come back, and you're going to call me a fake guru. You don't know what you're talking about. It doesn't matter that you've been trading for 16 years and that you've been successful, all kinds of places, all kinds of dollars. No. The one trade is all that matters to me, Chris. You get it wrong, you're done, right? 25% of you are going to act like that. The other 25% of you are going to change your lives. You're going to create generational wealth. You're going to understand that this is a game that can be played successfully if you know what you're doing and if you know what you're looking for. You get to choose which one of those people you are. You get to choose that. Let's do a couple more questions. Willie, a pretty easy question here. Oh, I quit screen sharing for a moment there, didn't I? Pretty easy question here. How do you delete stocks you no longer want in your favorites? It's so easy, my friend. If you create a stock that you love, and let's say IBN. I've actually traded this one not all that long ago. You can click the little star button, and you can say, add that to my favorite list. Maybe add that to my current portfolio. Hit OK. Symbol added successfully. You can come over here to your watch list. This will show you IBN, right? IBN this stock. And you can say, you know what? I don't want IBN anymore. Just hit the star. And you can remove it from whatever list it's in. Hit OK. Just like that, it's gone. And here's where you can change your different lists as well. Makes it super simple. Super, super simple. All right, let me see if there's anything else. Let me see. Hold tight, hold tight. Running through this screen or running through all these chats here. Ryan says, never ever move your stop loss. Exactly. Okay. Let's talk about the donkey channel. So this is something that is very, very new inside of Outlier. When I say new, we've had the data the whole time, but we didn't know how to best read it. And only in the last couple of weeks have we figured this out because of that losing streak I went through. And as I had told you before, I took a mid-year review and said, what can I do to make sure the second half of this year is wildly more profitable than the first half? And I mentioned earlier, right? Those Monte Carlo results are nowhere close to good enough for me. That's 10 times less than what I wanted to see. That's literally 10 times less than what I want to see in there. Okay. Because of that, that motivated me. Where can I go and improve my trading plan? So we had this data here in our market breadth tab. And the thought was, can I use this? How can I use this? Right. We use this number over here. This shows us how many buy or sell signals are in the full stocks or individual sectors or anything like that. What about this data down here? This shows you how many stocks have an uptrend versus a downtrend in whatever sector you're looking at or for the whole market. Now, let's define an uptrend. An uptrend is the 10 over 20 price over 50. You can apply this on any chart, anytime. Literally, on the 5-minute charts, on AMD, it's an uptrend. On the weekly charts, on SoFi, it's an uptrend. Okay? Doesn't matter. Every stock, every time frame, every single time, because it is math. You cannot argue with me. You cannot argue with it. If those three lines are stacked on top of each other, that is a bullish trend. Guess where I got that from? My friend Steve Burns in this book right here, New Trader, Rich Trader. In fact, it is on, since you asked, I know you asked, it's on page 106 of this book. Page 106 of this book. 10 over 20, price over 50. Okay, that's the outlier trend template. Now, if it goes the opposite direction, that is a downtrend. 10 under 20, price under 50. And then there's sideways trends. You can see all three right here. What this measures is how many stocks are in uptrends, downtrends, and if it's not in a trend, it's not shown on here. Now, one thing that in fact, our CEO, Mahesh, was telling me that this is his most important data point that he personally uses. And so we were coming up with some ideas on how to improve the win rates, how to improve profitability. And we got to talking. I'm like, what if we used what's called a Donchian channel? A Donchian channel, let me add a Donchian channel on here for you so you can see what it looks like. Let's do a different stock so it's easier to see. A Donchian channel is an indicator that every time you have a higher price will push up higher over X number of periods. And you decide that period. For Outlier, we found 4 to be optimal. This is default at 20. If it's not pushing higher, it's a flat line. If it pushes higher, it moves that up, right? So over 20 periods, if this moves higher, it'll move higher. And the same thing with the lows. This is the low price over the last 20 periods, which corresponds to that candle. And then that will move up and find the low price over the last 20 periods. Everybody got it? This works both directions. Now, looking at this, we're like, okay, can we apply that? Does this make sense? And so we have some very brilliant outliers who helped us create a bookmarklet that allows us to see when these push higher. How cool is this, right? So we have the 4-period Donchian on here, and the highlighted bars are when it pushes higher, and the red bars are when it pushes lower. So we now score these. So a score of 1 would be like this period right here, where it's pushing higher on the upside, but nothing's happening on the downside. That'd be a score of 1. A score of 0 would be like this one right here, where it's not pushing higher or lower either direction. A score of 2 would be when it's pushing higher, meaning closer to 0 on the downside, and pushing higher, meaning away from 0 on the upside. That'd be a score of 2. Now, what I found was that if we combine that on the market and on the sector to get a score, which I just showed you how to score these, of a 3 or a 4, my expectancy skyrockets compared to everything else. There are only the only possible outcomes are from -4 to +4. If we run the donkey channels in conjunction with everything else we do in Outlier, which we call the Outlier 9, as part of the market breadth, because it still fits in the sector breadth, still fits in market breadth, it doesn't change that. And we use a score of 4 or greater, my return, these are my actual returns over the last 2 years, have been tremendously higher, unbelievably higher. Guess what Chris is going to do from now on? Only trade with 3s and 4s. Can't do it otherwise. Can't do it otherwise. M. Jackson Jones says, I finally made the 90% back. Absolutely. It was a good hard lesson. Fast forward a bunch of years later, I will not lose a bunch of money. I have no vested interest. And there you go. Exactly. My man citing page numbers like he's a preacher. I don't know if you guys know this, but I love this so much. And if you want to be successful in this game, you need to develop a passion. I don't ever want you to come to the stock market thinking that this is a hobby. If you think that this is a hobby, you are going to be a loser. Just a fact. But if you think of this as if you are a professional fund manager, and I am going to allow you from this moment forward, go update your LinkedIn resume, say, I am a professional fund manager. Because if you are managing your money, you're managing a fund in the market. The objective here, though, is to be a profitable fund manager. I want that for you. Now, you can't do that on your own, right? You can't just sit in your library and then say, I'm a professional, profitable fund manager. No, it takes a lot of work. It takes a lot of time, effort, and dedication. But once you understand how to play this game, it will create generational wealth for you and all of your descendants, which makes it absolutely worth every single moment that you're going to spend working on this. Now, listen, if you're ready to save time, make money, and start winning with less risk, there's going to be 2 videos popping up right here. You are required to watch at least one of them and have a fantastic day. We'll talk soon.